The trading industry has spent decades deceiving you with the same idea. Learn chart patterns, learn setups, learn technical analysis, and eventually you'll become profitable. That's the promise. It's in the courses, it's in the books, it's in the mentorships, it's in the videos, trading communities. It's taught by different teachers. It's given different names to make it feel like a different system. But underneath, it's all rooted in the same lie. The patterns create an edge. So traders spend years searching for a better setup, a better pattern, a better confirmation. Let me show you why the logic behind technical analysis doesn't make any sense. You see, technical analysis relies on patterns, but patterns aren't what they seem. Imagine I throw 1,000 marbles onto the floor. Patterns will appear, shapes will appear, clusters will appear. You could probably circle some of them and give them names, but do they mean anything? Or are these patterns simply a result of marbles being thrown on the ground? Now imagine I threw 10,000 marbles, or 100,000. Would you expect more patterns to appear? Of course you would. Not because they mean something, but because they naturally appear whenever enough data exists. And markets generate far more data than a pile of marbles ever could. Millions of transactions, millions of buyers, millions of sellers, millions of interactions every single day. So why wouldn't patterns appear? In fact, it would be strange if they didn't. And this is where traders make a mistake that quietly destroys their progress. Because if patterns naturally appear in large data sets, then finding a pattern proves almost nothing. Unlike most things traders are taught online, researchers have actually tested this. One study by Sumit Ohawat, sorry if I didn't pronounce that right, I definitely didn't, but basically one study that he done examined different chart patterns across different decades of market data, and what he found creates a huge problem for the way most traders think. Quote unquote, the study reveals that no pattern produces statistically and economically significant profits for a cross section of stocks and indices analyzed. However, he noticed that some bullish patterns performed better in bullish conditions and some bearish patterns performed better in bearish market conditions. Think about that for a second. How could the results change if the patterns stayed the same? Well, according to the research, part of a pattern's predictive power could be explained by the market environment it appeared in. So, this should completely change how you think about technical analysis. Because if the outcome depends on the environment, aka the price action surrounding the pattern, then how can a pattern produce an edge? This is where most traders make the same mistake they make with timeframes and confirmations. They give the credit to the thing that stayed the same instead of the thing that changed. Imagine two breakout trades. Both use the same breakout pattern. One wins, one loses. Most traders look at the winner and conclude breakout strategies work. But stop for a second and look closer. One breakout formed while price was moving directionally. The other formed while price was chopping sideways. The pattern stayed the same. The surrounding price action changed. So do you think the trade worked because a pattern appeared, or because of how price was behaving before the pattern appeared? Most traders give the credit to the pattern because it's the thing they've been told to focus on. And this is where the entire lie is exposed. Because if price action surrounding the pattern is what determines the outcome, then why are you focusing on the pattern? Think about how backwards that is. Traders spend years trying to understand shapes when the thing influencing whether the shape works is the price action that the shape appears in. The goal of trading was never to find the better patterns or discover the perfect setup. The goal of trading is to understand what price is doing, because you don't make money by using a specific pattern. You make money by positioning yourself with the current price action. And that's the shift that most traders never make. This is why the trading industry lied to you, not because patterns never work. Sometimes they do. The lie is that patterns are presented as the source of the edge, because patterns are easy to sell, easy to teach, easy to recognize. But understanding price action isn't, which is why traders are taught to search for patterns instead of understanding what price is doing. But once you realize the difference, you stop asking what pattern should I trade and you start asking what is price doing right now, because the edge was never hiding inside of a shape. And if you want to understand how to read and position yourself around that price action, watch my video on how to beat 90% of traders.